Hello and welcome. Thank you so much for taking the time to join us tonight. I know, especially as women in business, you are all very busy, and we really do appreciate you taking the time to join us tonight. And with that in mind, we're going to jump right into things because we want to give you the most amount of benefit for your time, as we know how very precious time can be. I want to start off by sharing a few statistics. Some of these you probably already know, some of them are probably a bit of a surprise for you. One in particular, 90% of women will be the sole financial decision maker in their lifetime. That's a really important fact to keep in mind. By 2026, women will control 50% of the wealth in Canada. Women on average live longer. They have increased responsibilities when caring for generations both up and down. They will be responsible for the larger portion of estate transfers. Women are graduating university in numbers that are increasingly more than men and are increasingly becoming the primary breadwinners in the house. So, all of that to say something we already know: women's financial needs, goals, attitudes are different than men's. And it's really important to keep that in fact in light and focus on that. And as women, we need to help each other out. Women need to support each other. We need to look at each other's unique needs and help, whether that's finding the cheapest place to get diapers and supporting that way, whether that's creating a financial plan that focuses specifically on your goals and your unique needs as a woman, whether that's talking to each other and providing support when it's caring for generations both up and down. It's all really important. So that's some of the things we're here to do with you tonight. We want this to be a very supportive environment. So if you have any questions, please feel free to ask them either during the presentation or reach out. We're happy to answer them. We want to be here to support you and your unique needs. Our agenda for this evening, we're going to talk a little bit about your life, your goals, and why the right financial advice matters. Then we're going to dive into 6 key topics that matter: how business owners and professionals build wealth, the benefits of incorporation, maternity and parental leave, protecting your wealth and your family, retirement planning and investment planning specifically for women, and taking care of the next generations. We're going to put all that together by going through a case study. Then we'll go through a little bit about us and who we are and have a summary. And then, of course, we're here to answer any questions you may have. As we move through today's discussion, I want to emphasize that financial planning for women is about you. It's about bringing clarity to your unique situation. Everyone is different. So whether you're looking to grow or protect your wealth, it's about you and how your money can provide security for your life, and the lives of those you care about. So with that in mind, let's chat a little more. Again, women are unique. We have different opportunities in life and different realities, some of which may be a challenge. So when we put a plan together, we need to consider those unique scenarios. Women statistically live longer than men. That means that there could be greater retirement needs. You need to fund a longer period. Healthcare costs can also go along with that. An unfortunate statistic is that 72% of Canadians living with Alzheimer's are women. So there's some serious healthcare needs and things to take into account when talking about retirement planning as a woman. Caregiving for both children and aging parents, women are more likely to take that burden on themselves. That means time spent out of the workforce often. It can be financial costs. It also means stress and pressure on you. There's a lot to be done. And when you're shouldering that, that can really put a lot of extra stress and pressure on you. So how do we protect against that? What can we have in place? On the plus side, women are getting a growing share of wealth. That means an increased success from careers. Let's plan, let's use that, and let's invest it and talk about that in a way that works for you. As I said earlier, women also tend to want to take less risk and be more security focused. So how do we build that into your plan? And then lastly, inheritance and wealth transfer often will fall on the female shoulders. So we want to talk a little bit about that as well. Let's start off by talking a little bit about how business owners create wealth. So business owners and professionals create wealth in a few different ways. So at a starting point, they create wealth the same way as most average people do in Canada, through RSPs, tax-free savings accounts, non-registered accounts, as well as real estate, your house, those types of things. Those are everybody has access to. Now, if you're an incorporated professional or business owner, you may also have corporate investments that can form a very large part of your wealth. If you have a business, you may also have a value in that business that can hold a very large part of your wealth. And, some questions to that you need to look at. Can that business be sold? How will it be sold? What's the value? And how is that also going to be harvested as part of your financial plan? So let's start by exploring the benefits of incorporating. If you're not incorporated, you are limited more so to the personal things we talked about. So let's take a look at that. First, one of the main reasons people incorporate is for limited liability. That may or may not apply to you depending on the type of business you're in. If you're a professional, a doctor, an accountant, a lawyer, that limited liability does not apply to you the same way that it would apply to somebody who owns a landscaping company, or a plumber, or a type of career like that. So even if that's the case, you still have benefits of incorporating. And those benefits typically are for tax and wealth building strategies. So there's three different benefits of incorporation we're going to focus on. First is the capital gains exemption. Now, what happens when you sell your business is you may or may not have the opportunity to have what's called the lifetime capital gains exemption. That capital gains exemption can have huge value. It could mean that if you sell your business, you are able to access $850,000 from the capital gain tax-free. That can have huge value. Now, I'm not going to get into the details of exactly how we make sure that capital gains exemption happens. There are definitely some rules around that, but it is very in-depth in and of itself. We do an entire hour presentation on capital gains exemption, income splitting, and tax deferral. So just knowing that it exists and that if it's something that applies to you, you need to get more information on it. The second reason people look at incorporating is income splitting. Now, the rules have changed a little bit since 2008. There was what we call TOSI rules put into place, tax on split income, that do make it more difficult to split income with spouses and children. However, there are still opportunities available for you to do that, especially in retirement. So tonight we're going to focus on those opportunities in retirement. Again, we're not going to spend too much time going through the limitations pre-retirement and how to get around them because it is very in-depth as well. But if you have questions, reach out. We'd be happy to invite you to another seminar or provide some information one-on-one. Lastly, and what we're going to spend more time on this evening, is the tax deferral piece. And that can have huge benefits in terms of how you save for retirement. So the best way, in my opinion, to kind of understand the tax deferral and the opportunity there is to look at a case. So we're going to look at the case of Linda. Linda is 36 years old. She's currently single. She's a sole proprietor of a successful business that she runs on her own. Right now, she's unincorporated and she's trying to decide if she should incorporate. She earns $200,000 a year, and of that $200,000, she needs $65,000 to cover her personal expenses, her mortgage, her gas, her groceries, a little bit of fun on the side. So let's look at what life looks like for Linda as a sole proprietor. As a sole proprietor, Linda pays $74,000 in taxes on the first $2,000 of income she has. She spends $65,000 on lifestyle. That leaves her with only $61,000 to invest after expenses. What if Linda were to incorporate? If Linda were to incorporate, she would only pay $13,000 of taxes on the active income in the corporation. She would have a salary that she could take of $90,000 to net $65,000 personally. That covers all her spending needs. And that leaves Linda with $97,000 inside the corporation to invest and take advantage of tax deferral opportunities. That's a great deferral strategy. We talk about this a lot in terms of how corporations can be used to build wealth and build wealth for retirement. As I showed in that first slide, you have more money available to invest for retirement inside a corporation. And this is usually where the conversation ends when we talk about the value of incorporating and deferring. But as we've said, you're a woman. Your goals are different. You need to look at things with respect to your life and talk about why that matters. So let's take a minute to pause and assume that maybe Linda is not going to be single forever, or perhaps is going to have a family someday. And let's talk a little bit about parental leave, how it works, and then we're going to go back to Linda and bring her into this conversation again. So when we talk about parental leave, as a business owner, as somebody who's self-employed, you have the choice of whether or not to pay into EI. Typically, the reason you would pay into EI is for the parental leave benefit. So if you choose to pay into EI, you can pay the annual amount. It's just under $1,000 a year into EI. If you're thinking of having children, the question becomes, is that worth it? So the maximum benefit you can get on maternity or parental leave, is $638 a week. Now, parental and maternity leave are actually not the same, even though we tend to use the words synonymously and substitute them. And it's important to know the difference. So there's 15 weeks of maternity leave. Maternity leave is given to the mother who births the child. So that's the maternity leave part. After that 15 weeks becomes parental leave. Parental leave, there's 35 weeks of parental leave, plus an additional 5 weeks of spousal leave that has to be taken by a different partner. So you can't take more than 35 weeks of parental leave. You can divide those, however, the 40 total weeks, however you want, as long as one doesn't take more than 35 weeks. So if you do the math on that and you say you're going to work for 25 years, let's assume, you're going to pay about $24,000 into EI based on today's rates. And if you took the maximum amount of parental and maternity leave for having a baby, you'd get about $32,000 in leave. And that sounds good. It's a pretty good return. However, you need to ask yourself some questions and you need to plan ahead. Can you leave your business for a year? Is there an opportunity for your spouse to take a leave and get the top up? Keep in mind that if you are doing some work in your business, your parental leave is offset by the income you're earning in your business. So you may not get the full amount. Also, when we talk about the spouse being able to take the leave, the spouse can actually take the majority of the leave, the 35 weeks, based on them paying into EI. So you're actually double paying for that 35 weeks if you think of it that way. Perhaps you're better to look at taking the 15 weeks of maternity leave plus the 5 additional weeks, which is only about $13,000 per child. So it's really important to note these things. And I'm not saying what is right for one is right for the other. It depends on how many kids you want to take. It depends on the type of business you have and if you can take time off and step away and go back into it. It depends on your spouse and what they do and whether they have the opportunity to take that time off and or maybe even be topped up. But I think it's important to plan ahead and realize that this matters. Let's go back to Linda that we were speaking of earlier. And let's bring in some parental leave. So the same information applies, but let's assume Linda has already made the decision to incorporate, and she's now planning ahead for what if she wants to have a baby. She knows she wants to have a family in a few years. So in option 1 as the sole proprietor, she paid $74,000 in taxes, she spent $65,000, and she was left with $61,000. In option 2, she only paid $13,000 in corporate taxes. She took a salary of $90,000 to spend her $65,000 personally, and it left $97,000 inside the corporation to invest and on a deferral basis. Now, Linda could leave that for retirement, but let's assume that she has a baby. Linda now has $97,000 inside the corporation she can use to fund her parental leave. Even if she does not earn income working that year, she can take a salary of $90,000 to net the same $65,000 to cover all of the expenses on her year of parental leave. Linda's effectively split her income over 2 years and ensured that she had enough money to take the time off that she wanted to. And she still has $7,000 remaining in that corporation, which can be used and deferred for retirement. So there's a lot of value in taking this conversation a step forward, talking about it with respect to women and a little bit different than perhaps the way men plan when it comes to incorporating. An interesting fact that I believe is really important to bring to light is the fact that because women have different needs and different planning objectives, most women actually leave their existing advisor after the death of a spouse. And that brings to light that perhaps that existing advisor isn't focusing enough on you and your needs in this relationship and as a couple. And one of the needs women have is to discuss protection. It's something that is unfortunately, sadly, not discussed enough. Women actually do have less insurance than men do, statistically speaking. And it's really important to consider that. I think we can all relate to the fact that there can be a lot of stress on women. And that stress is a very, you know, bad thing when it comes to your health, unfortunately. So I want to talk a little bit about the different types of insurance that are available and things that you can put in place to protect yourself. There's life insurance, which we're going to get a little bit more detailed in a few minutes. Disability insurance, which again, I'll come back to. I want to point out critical illness insurance. Critical illness insurance is a type of insurance that you can purchase that provides a lump sum benefit for you to do whatever it is you need upon having one of these critical illnesses. There are many different illnesses listed out there and covered under the policy, the big three being cancer, heart attack, and stroke. So having that little bit of extra wiggle room to go out and get support. And one thing we don't talk about as much as we should with critical illness is the benefit of putting it on a spouse and or your children. I have 2 young kids at home, and I can tell you there is nothing that would keep me away if, heaven forbid, they had a critical illness. I would be selling everything I have to be by their side in Toronto at Sick Kids, if that's where they needed to be, CHEO, you name it, I'd be there. Having a critical illness insurance policy on your kids could allow you the flexibility and the freedom to do that. Having one on your spouse, I joke, but we all talk about a man cold and you know how needy they can be sometimes then. Well, imagine there was actual critical illness. A lot of that care, a lot of that burden's going to come on you. Your spouse may get disability coverage and have the ability to take time off work, but it is going to affect you if they are off work, if they are sick. So having that buffer in there can have huge value. And that can actually be built into a plan where we add a return of premium. So if nothing happens, let's all hope and pray that we are the lucky one who nothing happens to and nothing happens to our family. Well, then you can get a return of premium put on that and use the funds for your retirement. It's a really important piece to consider. The other one I want to take a moment to consider and talk about is long-term care. Long-term care insurance allows you to get the support either in a home or to have somebody come into your home to support you when you need that care as a senior. We talked a little bit earlier about the burden of caring for generations, both up and down, that falls on women. Again, I have 2 daughters. What can I do to make sure that they don't have the same burden for their generation that we have for our generations and generations before us? Is there something that I can put in place to know that my long-term care needs are going to be funded? If I am one of the unfortunate people with Alzheimer's, my kids aren't taking time off work to look after me. When we talk about disability insurance, as a woman in business, there's 2 types of disability insurance you need to consider. Your income, for sure, is just personal disability insurance. Your greatest asset is likely you, your income, your ability to produce that. Your house, your investments, those are all great, but you are your greatest asset. The other type, of course, is overhead expenses. Women tend to be disabled more than men. It is an unfortunate stat. We also tend to have longer disabilities than men. That doesn't mean that you're not going to want to come back. Very, very often disability claims last 1 to 2 years. 1 to 2 years of being out of your business, you may want to step right back into it when you're able to. So overhead expense can allow the regular fixed expenses of your business to carry on while you're off. So there's something to come back to when hopefully you're better. Talking a little bit about life insurance. And when you talk about life insurance, there's 2 types of life insurance. There is term and permanent. Term is really important in that early stage of the human life cycle. That's when you have bills and children and people you're responsible for, and they rely on you and your income, and there's life insurance. Permanent insurance is something that can be used and built into your plan in the future. That's when you have a need for tax planning, estate planning, when you want to pass money on to future generations to take care of them. Permanent insurance can be used for both retirement and the ability to access cash flow in retirement, and to leave a much more efficient estate to your kids. So if that's something that's important to you, it's really something you should have a discussion about and see if it's something that may or may not fit into your plan, both on the retirement and the estate planning side, especially if you are incorporated. As we discussed earlier, may be an important piece for you. So now let's talk a little bit about retirement. As we spoke earlier, women are more likely to live longer. We have more unique needs when it comes to retirement. We have to fund longer life expectancies. We have to consider healthcare and what living longer may mean. We also want to talk a little bit about the markets and inflation. The longer you live, the more opportunity inflation has to erode your wealth. And lastly, we also want to talk a little bit about asset allocation because we spoke earlier that women in general tend to want less risk and less volatility than men, which means their portfolios may need to be designed differently. So when we talk about retirement income, there are many different potential sources of income. You can have CPP, old age security, RSPs, RIFs, investment income, flows from your corporation if you're incorporated. Maybe you earn some income continued. There's annuity payments, and all of these pieces need to be considered and work together. It's really important to talk about sort of the questions that you should have and how you look at things because not every dollar is created equal from an investment standpoint. So first you need to start with why. Why are you saving this money? What is it that you're hoping to accomplish? Why? Have that reason for you. When do you want to retire? When do you want to spend it? Then we talk about where you save it, what you invested in, and how you're going to withdraw it, and how you're going to have a plan that actually takes advantage of everything and looks at the differences of all of these pieces. And that's really important because, as I mentioned earlier, not every type of income is taxed the same. So what you get to keep needs to be taken into account. Unfortunately, interest income and dividend income has a higher taxation than a capital gain or return of capital. Interest income is what's typically earned on more conservative investments. So you need to keep that in mind. The same is true for corporate. However, it's not the same rates for corporate. So what is efficient personally is not the same as what is efficient corporately. And knowing this and understanding this, and then understanding what your goals are and what's important to you and the type of investment and volatility you're willing to handle, all of that needs to go into place when you plan where do you save your funds? What do you invest in what box? And how does that look? As we mentioned, women do like to have lower risk investments the majority of the time. That may or may not apply to you, but if it does apply to you, then you're going to have some interest income, which is less tax efficient. So then we need to look at how can we get more tax efficiency and save more to last longer for your longevity. And one option that may come into place is using an IPP. So an IPP is kind of like an RSP, but it's like an RSP on steroids. It's a little bit bigger, a little bit better, and it allows you to put more away for retirement. So what exactly is an IPP? An IPP is actually a registered pension plan. It's a defined benefit pension plan that you put in place specifically for owners of the company. So if you own your own business, you're incorporated, then you may be a candidate for an IPP, and it is a designated plan under the Tax Act. When we talk about an IPP and what the benefits are for an IPP, we talk about why you would do this. And the reason you want to look at an IPP is because it allows you to put more money away for retirement and have it grow tax deferred for your retirement. So deferring that tax on interest or income or capital gains until ultimately you pull it out. When deciding if an IPP may or may not be right for you, we have to look at you in particular. So as the shareholder, typically you want to be at least 40 years old, earn a significant salary on a consistent basis. You want to accrue retirement income outside of the company in a tax deferred way, and you're looking for creditor protection for your retirement savings. The company also matters. So the company should have positive annual cash flow or accumulated assets. And needs to be willing to commit to the annual funding levels and costs of an IPP, because an IPP actually mandates that the company saves money for your retirement on an annual basis. And as I said, the funding levels of an IPP are higher than an RSP. So it's really allowing you to put more money away in a tax sheltered environment and defer that. And the reason I said age 40 is because that's about where the break even is on how much you can put into an IPP versus an RSP. So as you can see here, if you happen to be a 60-year-old who's looking to grow and enhance and get your retirement set up, you can actually contribute $40,000 to an IPP versus the $26,000 to an RSP. It's also a great way to get money out of a company if you happen to be in that age range, that 55, 60, 65, and you're considering selling your company and you want to make sure that you qualify for that capital gains exemption we spoke of earlier. Then once you retire, that IPP again can be used to provide you a retirement income and focused around you. So we talk about that and we say, it could be used as similar to an RSP. You could actually move it into a locked in retirement account and open some up in an RSP, take it out that way. You can use it to purchase a life annuity contract and know that you have a consistent income for life and you don't have to worry about those risks. Or you can have it pay a monthly benefit directly out. These are the options available to you. So we've talked a lot about different options and different things to consider when building a plan. I believe the best way I learn anyway is to see things in action, see examples, and look at case studies. So we're going to talk a little bit about a case study here, and we're going to go through our living plan and look at how we can use that to model things out and help make decisions. So today we're going to talk about our Dr. Emily Chan. She's 35 years old and currently self-employed. She has a husband, Victor, and they have done a great job saving. They've actually already paid off all her medical debt for medical school. They've started savings and they really want to push towards their goal. They've been very career focused, but also goal focused. Their goal is to save enough to maintain their current spending levels in retirement, adjusted for inflation. So they don't want to see a step down in what they're able to spend in retirement. And the first question that was asked was, does it make sense for Dr. Emily Chan to incorporate? And we decided that we would take this opportunity to go through a plan. Let's look at where she's at now, and then we're going to layer in how things and how answering some of these questions work for her. So when we looked at her living plan, we looked at her income now, minus the taxes she pays now, minus her expenses for her lifestyle, and that gives you savings. Those savings are then going to create a retirement income for them, minus the taxes and expenses. So you have that retirement income ready to go. You have to pay tax even in retirement. You're going to cover all the expenses, which they want to maintain the same amount of expenses they have now. And what's left over is going to be the net estate. And we're going to use that net estate as a way to talk about the success and the value added to the plan because it's a great single snapshot of it. And we're not going to adjust the expenses because we already know what they want to spend in retirement. So first, we want to look at where they're at now. We want to calculate a detailed cash flow, savings, taxes, and look at what it's going to look like if they want to fund 60 years of retirement spending. We're going to have them live till age 95. And we want to continue to assume that they're just going to save as they've been saving anything that they're not spending right now. And we're going to look at the estate. So they're doing a really great job right now. Their estate, without any recommendations or plans or anything put in place, is just shy of $18 million. Now that sounds like a very large amount of money, but you do need to remind yourself that that is an inflated amount of money. So when we bring that back to today's dollars, that's a $5.5 million estate. Still a great estate, but it is inflated a little bit there. So again, we want to be confident in that. We want to look at the what ifs, right? The variability, because when we use an average rate of return for a moderate investor, in this case, we've assumed a 60-40 split, an average rate of return of 4.7 per year, net of fees, but not taxes. Well, when you say average doesn't happen every year. I think we can all agree on that and know that there's some ups, some downs. So what if the sequence of those returns happen differently? How does that affect the plan? What if you had all negative stuff in the beginning and all positive stuff at the end? You'd still have an average of 4.7, but it would affect the plan. So we want to run what's called a Monte Carlo analysis. We give you a grade on your plans. You're 100% successful, but are you 100% successful 100% of the time? What's your grade? In this particular case, their plan was successful 97% of the time. They were able to cover 90% of their spending goal 97% of the time. So that's a pretty good grade. So we're going to leave that there, knowing that they had a good grade. And now we're going to layer in some answers to some questions and some opportunities for Dr. Emily Chan. The first one is, should she establish a corporation? If she were to establish a corporation, she could pay herself $150,000 of salary and then retain the rest inside the corporation to invest. She'd be able to split dividends with her spouse after age 65, and she'd have more money to continue growing for her. So let's look at what that looks like. So she has her income now. The taxes she pays now actually goes down. They're still able to cover the expenses, and the savings they have now for retirement go up. In retirement, they have more retirement income. They're going to have lower taxes on that income because they're going to be able to split it in retirement. They're going to be able to have expenses and net estate. Now, the taxes on that estate are going to be higher. So we need to factor all that in, rerun the same plan with the same spending goals, relook at the same cash charts, tax charts, all the way through retirement and estate, and look at what the net estate is with this change. So the benefit of incorporating to Dr. Emily Chan in this particular case is it adds $5.5 million net to the estate. The tax savings over the course of her working years, deferring that tax, growing the investments, and then the lower tax really adds a benefit. Next, we're going to say, what if she also wants to have an IPP? She wants to look at the option of having more security, having more invested in retirement plans outside of the corporation that she can access during retirement and being more secure. So again, we're going to run all the same numbers. We're going to look at the cash flow. We're going to look at the tax implications, and we're going to see what the benefit is to the estate. The benefit to the estate in this case is $1.5 million. Now, keep in mind, Dr. Emily Chan is 35, and we said you would be better off to do this at age 40. So we're using some different assumptions in here. We may not do this right away in a real life case, but we wanted to show it. The other thing is this IPP is allowed to provide, she can take as a annuity. So while it may not provide a huge increase to the estate, it provides a lot of comfort. So it's about you again. What's more important to you? Is your comfort, is your reliability something that's more important to you? Well, maybe this has more value. So the next thing we looked at was portfolio shift. So because we provided more comfort by having more assets for retirement through incorporating, as well as putting the IPP in place, now Dr. Emily Chan and her husband Victor are more comfortable with taking on a little bit more risk in their investment. So they're going to shift from an asset mix of 60-40 to an asset mix of 70-30. And what that does is that's going to give a slightly higher rate of return. Typically more risk has a higher rate of return long-term, but it's also going to change the type of investment return to being more efficient. More equity tends to mean more capital gains as opposed to more interest income. So you get to keep more of it. Again, we're going to run all of this, the tax implications, the spending. We're keeping the spending the same for 60 years. And we can see that the net value added to the estate in this particular case was another $3.9 million. The last strategy we're going to show in here when we talk about adding and layering these in was there's a large estate. We've gotten through that. That's quite a substantial estate. And some of these strategies we put in place are deferring tax, meaning there's a large tax bill on death. So we're going to look at whether having an insurance policy, a whole life policy for estate planning purposes makes sense. We're going to assume that they're going to put $15,000 a year of savings into this insurance policy. And we're starting with a whole life plan that has a guaranteed death benefit of $825,000. So again, we run the numbers. What does that look like to the estate? And what you can see here is it's added another $1.5 million in value to the estate. And this is not to say that you necessarily want to put all of these things in place every time. That's not the point of showing this. The point of showing this is that having a plan, using the software, and going through can add a lot of value. In this particular case, we added almost $12.5 million to the estate. That's a 70% increase for taking the time to look at the options and what's important and putting it in place. And again, this is an example. It's not meant to be about you. You need to think about your living plan from your perspective. While we've been generalizing stats about women tonight, we are all individuals. We are all different. We all have different goals, different needs, different passions. And that needs to be taken, into account in your plan. It should be around you. You should have a team that works around you as well. You should be the center. You need lawyers, you need accountants, you need a financial planning team as well. That should include experts. In our case, we also bring into account, tax and estate experts. We talk about insurance, mortgage planning. We have preferred partners when it comes to some of these things that we put into place from an investment planning perspective. We have lots of access to tons of different people out there in different companies where we get more information from, insurance as well. Our team and how we like to do financial planning is our local team here includes myself, Jake, Chandra, and Aaron. And we work as part of a team, all surrounding you and what you want to put into place. Our team is positioned very uniquely, we believe, to help our clients. We are part of the Investors Group Securities Inc. side, little different than the old Investors Group Financial Services, but both are part of the IG Wealth Management, which is under IGM Financial and Power Corp. So we're very well positioned to bring in experts and be able to provide advice. We have access to any product, any investment type out there that we can bring into the plan that works based on you. But the goal is to do it around a comprehensive plan and a solution based on your needs, looking at, managing cash flow effectively, optimizing your retirement, taking into account that you may live longer. We're talking about sharing your wealth. It's important to pass things on to the next generation too, maybe not. Preparing for the unexpected. It can happen, and it's really important to have a plan in place. So those are all the pieces we like to bring together as part of our overall IG living plan. So I'm going to pause here with this slide saying, are you ready? Do you have a plan in place? Have you taken the time to ask yourself those questions? If you have, that's wonderful. If you haven't and you're looking for somebody to help guide you through this process, we're here. We're happy to help. Please feel free to reach out. You can click the button in the upper corner if you're interested in booking an appointment. We'd be happy to have a discussion with you. For tonight, we're going to leave it here. We really do appreciate that you've spent the time with us this evening and taken the time to put yourself first and ask yourself some really tough questions that I think we've posed to you. I'm going to pause for a minute and allow you to ask any questions to come in. I'm happy to answer them. If you have a question that you don't want to ask, absolutely book an appointment, send us an email. We are more than happy to answer them privately as well. Thank you. Oh, my favorite place to get diapers. Yes, I will answer that. I believe Amazon delivery was spectacular. They showed up, whether I forgot about it or not, they were there. I found that convenient. Okay, so going a little bit back to the capital gains exemption we talked about. Again, I'm happy to answer that in more detail, but essentially that is the value you get out of selling your business. So for example, if you have a landscaping business that you started up on your own, there's probably very little that went into starting it from a dollar perspective. It was mostly blood, sweat, and tears. And it's grown over time though. Somebody wants to come around and buy that business from you. If you qualify, and again, there is an if in there, it has to fall under the small business rules. It has to be what we call pure. There are ways to do that. You do want to plan at least a few years ahead before you start exiting. That should be a 5-year run-up ramp. But if you follow those rules, if you get everything in place, then you don't have to pay capital gains on that $850,000. So if you don't put it in place, $850,000 of capital gains are taxed at a 50% marginal rate, means you have taxable income of $425,000. Government's going to take about half of that in most cases, depending on where you're at, marginal tax rates, but it's about a $200,000 tax bill that can be saved using that exemption. Again, we can get into more detail if you have further questions on that.